The physical tension currently vibrating through the private banking suites of Raffles Place and the high-end offices in Hong Kong mirrors the collective panic when the MRT doors jam shut during the evening peak hour. Wealth bankers are frantically pouring champagne at hastily arranged luncheons, desperately trying to calm high net worth clients who are demanding answers. These investors just realized their capital is trapped inside the $1.8 trillion private credit market. The gating mechanisms of massive United States evergreen funds have suddenly slammed shut. They were promised a VIP express lane to double-digit yields, shielded from the volatility of public markets. Now they are stuck in a dark tunnel, surrounded by asset managers, blaming software sector volatility and artificial intelligence disruption for the sudden lack of liquidity. And look, on the surface, that makes sense. The financial textbook explicitly states that you must accept less liquidity in exchange for a higher yield premium. You buy private credit for the illiquidity premium. But here is the uncomfortable truth. The very structure designed to protect the fund is now a suffocating trap for the retail investor. When a fund manager caps redemptions to prevent a fire sale of unlisted loans, they do not eliminate the fire. They simply lock the doors, barricade the exits, and force everyone to inhale the smoke. The underlying assets bleeding, and the retail investor is acting as the sandbag. For Iggy's elite investors, who receive zero-day intel to navigate these shifts before the 7-day lag hits the public, this sudden panic is not a surprise. We warned about the liquidity illusion months ago, tracking the divergence between managed narratives and raw cash flow. Welcome to the pit. I'm Iggy, your guide through the Singapore market jungle, where 6,000 plus of us run the forensic numbers before mainstream media catches on. The red flags are always in the data. The gearing ratios, the occupancy gaps, the debt overhang, they don't hide. But you need the forensic breakdown before the market opens, not after the damage is done. Iggy's elite investors got the full red zone report before today's session. They saw the landmines before the price moved. All in for 9 Singapore dollars a month, less than a Ya Kun said. Stop being the exit liquidity. Now let's get into today's numbers. The smart money understands the psychology of the cocktail hour diversion. When massive asset managers start hosting casual drinks and Zoom calls in Singapore, just to reassure you about their balance sheet status, the institutional money has already sprinted for the exits. The mechanism is brutally simple. Retail investors in Asia are being utilized as the foundational liquidity buffer for American private debt. The psychological shock of a redemption queue triggers primal fear. You realize the private in private, credit simply means the manager does not have to show you the actual deteriorating price of the asset until it is entirely too late to sell. Translate this macro divergence into the local wallet and the danger becomes visceral. We are witnessing specific local consequences that will redefine retirement planning for the Singaporean household. This strikes directly at the heart of job and income stability within our financial sector. Relationship managers are working aggressive overtime, frantically trying to draw historical parallels to previous real estate gating events, hoping their clients will simply remain patient and stop demanding withdrawals. For the 55-year-old investor, relying on these quarterly distributions to fund their lifestyle or outpace the shrinking purchasing power of CDC vouchers, the income tap has been violently choked. If a major subsector like software loans continues to face artificial intelligence-driven markdowns, the resulting credit freeze will destroy the cash flow models of thousands of mass affluent retirees. It means your offshore passive income is entirely at the mercy of a Wall Street committee's gating threshold, rendering your retirement budget completely theoretical. This also exposes the profound structural irony of our local pension architecture. For years, aggressive financial advisors urged affluent clients to deploy their personal capital into exotic offshore credit vehicles because the Central Provident Fund and Supplementary Retirement Scheme frameworks were deemed far too restrictive. Yet as the offshore private credit market burns and gates slam shut, the rigid, boring structure of the CPF special account suddenly looks like the ultimate financial fortress. The risk-free floor of the CPF special account at 4.0% remains robust and liquid for its intended purpose, shielding you from the sheer terror of an illiquid mark-to-market bloodbath. It proves that chasing An opaque unlisted yield while ignoring your foundational domestic sanctuary is a catastrophic miscalculation of risk. The third impact fundamentally reshapes the dynamics of your domestic SGX portfolio. As frightened capital desperately attempts to flee the gated United States credit funds, we are seeing the beginnings of a safe haven rotation back to domestic stalwarts. Frightened money does not seek leverage growth, it seeks structural certainty. The major Singapore banks and blue-chip industrial real estate investment trusts, governed by strict capitalization rules and transparent non-performing loan ratios, represent the ultimate sanctuary. The local stock market, often dismissed by the younger crowd as boring and stagnant, is quietly absorbing the panic-driven capital of the Asian wealth class, who simply want to see their money safely accounted for every single day. The second-order effect retail investors completely miss is the contagion squeeze. When a high net worth individual is gated out of their private credit fund but still needs immediate cash for a property down payment in District 10, they are forced to liquidate their most liquid, highest quality public assets to raise capital. This means we might see sudden, irrational price drops in pristine SGX blue chips as wealthy investors sell whatever they can rather than what they want to. This creates a rare, temporary mispricing window for the astute kopitiam uncle sitting on cash. Are these offshore private credit funds entirely toxic? No. But we must filter their opaque reporting through the institutional math of our public markets to understand the true risk premium. Let us actually do the math on the balance sheets together. A true forensic auditor does not just look at the yield, we look at how that yield is manufactured. Because we are comparing different vehicle structures, we calculate the interest coverage ratio directly from the raw income statements. For a local giant like CapitaLand Ascendas REIT, the approximately 940 million Singapore dollars in operating earnings before interest and taxes easily covers the 260 million Singapore dollars in interest expenses. This generates a healthy interest coverage ratio of 3.6 times. While this is slightly below my preferred 4.0 times threshold, it remains serviceable. Meanwhile, our private credit proxy, Owl Rock Capital Corporation, is operating with an audited trailing interest coverage ratio of exactly 2.0 times against its $9.3 billion in long-term debt. That number of 2.0 times is a critical breach of my forensic standards. It exposes the raw fragility of the offshore private credit dividend payout. When an offshore fund sees its interest coverage ratio compressed to exactly 2.0 times, the double-digit yield is no longer generated by organic business strength, it is a mechanical illusion. The forensic models explicitly flag these vehicles for a poor free cash flow yield. If just a fraction of those software loans default, that 2.0 times buffer evaporates, the dividend is slashed, and the fund gates your capital. We must also respect what the secondary market is telling us. DBS is trading at 56 Singapore dollars and 97 cents. Practically perfectly aligned with its mathematical fair value of 57 Singapore dollars and 1 cent, sitting right near its 52-week peak. The market trusts the Singapore banking fortress completely. Conversely, the private credit proxy is trading at $11 and 11 cents, despite management claiming their internal net asset value is worth nearly $14. The public market is effectively saying they do not believe the internal math of the private credit managers, pricing in a massive 20% discount just to absorb the hidden risk. The smart money understands the durian stall discount. If a hawker claims his Mao Shan Wang is worth 50 Singapore dollars a kilo, but the entire market refuses to pay more than 35, the hawker is either delusional or hiding a rotten batch. The public market is currently slapping a massive 20% discount on unlisted offshore debt because they see the 2.0 times interest coverage ratio and smell trouble. Meanwhile, investors are willingly paying a premium for Singapore REITs and banks because transparent audited cash flow lets you sleep at night. Stop chasing an engineered yield when a 5.1% fortress yield pays your kopitiam tab without the heartburn. The data confirms the grim narrative playing out in the wealth management suites. The $1.8 trillion figure represents the colossal scale of the United States private credit market that is currently wobbling under the weight of higher interest rates. When a market of that magnitude experiences a liquidity bottleneck, the tremors are felt globally. Furthermore, the surging Asian retail credit flow of $48.8 billion proves that smaller Asian investors entered the party exactly at the peak of the cycle. You are abandoning the official 4.0% risk-free floor of the CPF special account to absorb the institutional risk they no longer want. For this audit, I am applying a stress test buffer using a conservative floor of 3.2% as our working risk-free benchmark. While the current spot rate for 6-month T-bills is approximately 1.36%, I test the thesis against this higher than spot hurdle. If the math holds at 3.2%, the margin of safety at current levels is a fortress. We audit for the storm, not just the sunny day. When we look at the yield spread, the math is simple. If a local tier 1 bank yields a reliable 5.8%, the mathematical reality is 5.8% minus our 3.2% forensic floor, which equals a spread of 2.6% or 260 basis points. This is well above my minimum requirement of 150 basis points. You must answer 3 forensic portfolio stress test questions today before the storm hits your shores. First, if your offshore income funds gate your capital for the next 2 years, how will you physically fund your daily living expenses without selling your primary residence? Second, are you confusing an illiquidity premium with actual fundamental asset quality and balance sheet strength? Third, does your overall portfolio possess enough completely unencumbered, transparent domestic cash flow to survive a global credit freeze? Translating these complex scenarios into forensic watch levels requires strictly adhering to the 25% concentration rule. Having a massive chunk of your liquid net worth tied up in unlisted offshore credit vehicles is a severe violation of my standards. If you have allocated more than a quarter of your wealth to funds that can unilaterally deny you access to your own money, you have surrendered control of your financial destiny. We must systematically rebalance back to transparency and control. These are the core strategic considerations for navigating the current tension. First, consider the liquidity pivot. If you are fortunate enough to hold uncapped capital or sit high enough in the redemption queue to extract your funds, consider rotating away from opaque structures and back into the SGX dividend stalwarts. You are effectively trading a theoretical mark-to-model double-digit return for a transparent cash-generating reality. The memories of the 2008 mini bonds and previous tier 1 capital wipeouts should serve as a stark reminder that complex offshore yield often masks catastrophic downside risk. Second, embrace the home ground advantage. Anchor your primary income stream to assets governed by strict domestic oversight. The regulatory transparency of our local banks and prime industrial real estate investment trusts is the ultimate antidote to the current wave of offshore gating anxiety. While other regulators are just now ramping up their surveillance of private markets, our domestic financial ecosystem already demands the highest levels of capital adequacy and public disclosure. For my own portfolio construction, I track these debt and liquidity metrics as a watch signal. This is a personal forensic boundary, not a recommendation. Using kopitiam logic, holding a transparent Singapore blue chip bank is exactly like owning a fully paid off 4-room HDB flat in the mature estate of Bedok. It might not possess the glamorous flash or dinner party prestige of a highly leveraged Sentosa Cove bungalow, but when the economic tide goes out and the credit markets freeze, you have a sturdy roof over your head and a practically guaranteed rental yield. The offshore private credit market, heavily exposed to software disruption and burdened by redemption queues, is currently functioning like a Sentosa Cove mansion built entirely on shifting quicksand. When the foundation cracks, you cannot simply walk away. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.